Hi, good evening. I just wanted to do a quick video on what I stated earlier, which is why crude oil is not a good candidate for the order flow craze. Now, first of all, to separate, we're looking here at order flow before, not footprint. So if you look at a footprint chart, for example, if I bring one down here, these are trades done. What we're going to be focusing on is what a lot of people are spending the time doing. The market's closed at the moment, so we won't be able to do all of the sections, but it's the order book, anything that's not yet transacted but is sitting in the GOB, the global order book (GOB). Whereas the footprint is transacted entity, it's a transacted volume. This is pre-transacted volume, so that's what we're going to focus on. Okay, kind of the first one is curve based, and this is the kind of base construct to everything in the crude space, which you can see. So if I go back here and just show you, if we look, we've got right here we've got Brent and the daily Brent volumes going all the way out. It peters off quite a lot, but certainly there's reasonable volume in Brent at the big quarters going out for the whole year, out to December 19, still 70,000 contracts. And then this is the spread volume as well. I separate the two. It's the reason I'll explain in 1 second, but you've got, this is the volume that's done as a spread. So this could be somebody, for example, buying 1 February and selling 2 June, and then buying one more, I don't know, it could be September, okay? All that counts as spread volumes, what a lot of people are doing. So you can see the kind of percentage volumes. So if we look, if I just get rid of that and go back to here, you'll see total volume on ICE is, where are we? Total volume on ICE is 1.1 mil. Oh, that's shocking. Sorry about that. Hold on. Where are we? Oh, that needs to be go. It's way smaller. Total volume on ICE for outrights was 1.1 mil and spread volume 1.6. CME, if we come over to this side, was 1.6 mil in total. The CME don't separate their spread volume, so sometimes you'll see the front month when the volume comes through, and you'll see it's been like an 800k day, and it will list it as a mil, and that's because they're adding that spread volume in. Whereas if you look at ICE will move that, so their front month was 463, and their spread volume on top of that was 130. So it's just the way the exchanges do it. But in general, they're there or thereabouts for their kind of core contracts. So you can at 1.8 mil there against kind of 1.6 mils. So they're thereabouts. Now we're looking at 2 separate contracts at the moment, but if we kind of bring in as well to kind of muddy the water even more as to where the volume is, here is ICE's crude oil equivalent. It does, admittedly, it does tend to trade predominantly in the front month, but it was 277,000, 238,000 on the big days that we were having previously as well. So it's 30% of the volume of the front month on the CME. So one of the things that's kind of important to note is you're not seeing all of the price action, and that's what a lot of people kind of miss out when they're staring at this order book. It's actually you've got a bunch of volume going on here in the front month. You've got a load going on here on ICE. You've then got a load of arbors between the two here sitting on the Brent contract. You're actually seeing a very small proportion of the total crude futures volume, let alone the physical. But let's just park that for 1 minute. And also got to remember is there's so much spread work going on as well. So if you look here, you can just see, the usual, this is the COT report, but just the size of the spread market compared to the outright market. It's always a bigger number here, always much bigger. And this kind of comes in as the point I'm trying to make is when you're looking at the order book and you're seeing, it's bid for 150, bid for 200, bid for 500, whatever that number might be, that's a lot of that volume, and I can kind of comfortably say 70% or more of that volume is spreader volume or arb volume. So you've got a bunch of market makers that are purely arbitrage guys that are looking at, all they're doing is they're being paid to quote into ICE. So they'll be putting a number into this market, and they'll be looking at offsetting that into CL volume. So what would happen to kind of describe that is if it's kind of 2022 on ICE, they'll be looking at people transacting with them at 21 and getting lifted at 22 on ICE, and they'll be doing the old kind of what was going on with the Bund pits between Frankfurt and London, 20 years ago. They're arbitrage guys arbitraging same contract across two exchanges, ultra fast, ultra low latency, arms race to the bottom. But those guys are looking at nicking relatively free ticks. So it's kind of one of the key things. The second thing is with crude is it's in the curve. And I hope in what I've kind of showed here, if we move this set of volume out the way, what I mean by when it's kind of sitting in the curve is, let's move this a little bit here and put a better color, is you've got, if this is the front month here, second month, third month, fourth month, fifth, sixth, seventh, eighth, all the way out for a year. Crude's got a curve. At the moment we're in contango, so the cheapest month right now is the front month, and then you go 6 months out. It's a bit so this curve makes an interesting play for the spreading market, which I've just showed before is the biggest market in our futures oil industry. And you could be looking at people saying, well, actually, this belly here between, June and September is incorrectly priced. So you might buy here, sell here, and buy here. You're basically creating a butterfly. You're not using an option, so don't get confused with an option. You're creating a future spread like a butterfly, or you can do a condor, or you can just do an outright calendar spread. You'll see people saying the spreads have blown out. And there's a lot of people will create these spreads. They'll do 1x3s or 1x2x3s. So they're overall keeping a mass direction neutral. So what I mean by a 1x2x3 would be you'd buy one front month, you might sell 2 second month, and then buy 3 third months, right? In the event of a complete collapse in crude or a total rally, you're kind of covered because you're sorry, that should be a sell, not a buy. Your kind of overall position is flat. Yeah, you've just got convexity position or curve position. So if crude front month just rallied up $5, you're not going to get hosed because these 2 months would hose you and this one would go up and cover you. You're looking for the variance in that. You would get hosed because the back wouldn't move as much as the front. But what people are looking for in this play is they're looking for a change in that curve. And this is where so much volume is. So I could have shown you when the market's open, but unfortunately I can't. My DOM ladder shows the number of orders that have parenthesis, which is basically it shows that the order's related to another spread, and the vast amount of volume that resides in crude is spread related. So when people are kind of looking at an order book and they're seeing, it's layering up here, they're spread orders that will have to have a defined leg distance to them. So what I mean by that is, if it's 2021 in the ladder, okay, 2021 it's 22 in the ladder, right? If I can draw, there'll be a guy saying, I want to bid 2 ticks out of the middle. So if it's that's the mid price, he's bidding here at 20. And if it quickly drops down, if he can't get the other side in the other ladder in the June or the September, he just drops his bid down to 19. And if he can't get out again, he drops it down to 18. And he's just moving all the time to make sure his leg's secure. And that's most of those prices that are going into the order book are relating to that. That's a kind of key thing to remember. That's the first kind of key thing to remember. The other thing is that everyone's there staring at the front month, and where are we? So, including if I could draw, even with the spreads, there's 987,000 in the front month crude compared to a total of 1.6 million traded. Plus, you've got to remember you've got to add in the 260,000 that's been done on ICE, because that's a full arbitrage contract that people are looking at the whole time. And then you've got Brent arbitrage as well. So you've got you're basically, from an order flow perspective, you're staring at about 25 to 30% of the market. And you have to remember as well is that most of that is spread driven, not directionally driven. So I could probably find you, if there's, take here for instance, right? There's a big order to sell here for 240. There's a buyer here that got sold into on the close. And I just wanted to bring in the equivalent other side is, where are we? I found that earlier. Here was equivalent buying going on. Hold on one second. So you got a seller here upon the right at the end of the day, and you got a similar. There was a buyer which I found in the June contract right here. Okay. Other side. Oh, I don't know why it keeps doing that. Sorry about that. You got the guy took the other side, and that's what's happening all the time. This was actually in the June contract. And this is where I kind of, for footprints, I can talk about that in another video. But the kind of a key thing to remember is that so much of the flow is happening in those spreads, is across months, is non-directional for the overall for the immediate movement. They're taking a spread position, and it's across exchange, and it's across crude products. So there's, much of the flow that's going on between the CME and ICE is the Brent ARB. Those 250,000 contracts a day that they're doing in WTI, I would say probably maybe 30-40% is that Brent ARB as well. So you're only seeing, when you're just staring at CL, a small amount of the picture. Now the CME has also built up a large compete against Brent. I say large. They're probably they're 25% maybe on a good day of the CME's of ICE's total Brent volume, but it's the equivalent back. They've kind of got this compete contract, so that reduces your percentage of the total picture that you're seeing at the same time. Right, what else did I put in this? I will do this as well when the market's live, so you can actually see all the parenthesis orders going in as well. So OI is spread out over 24 months. I think that's pretty clear as well. You can see the depth of OI right the way out. There's 100,000 contracts in December 20 still. 200,000 contracts in December 2019. There's more there was nearly as many contracts in the front 3 months OI as there is in the December 19. If you look at Brent, I mean, it's way deep. Separate sheet for that. Just hold on one second. Oh, sorry about that. I think I've closed that sheet. But Brent OI is just runs even deeper because most people are playing in the 1 to 3 year curve. So there's so much of that going on. Right. So hold on. Where was I? Curve based OI spread out. The ARB produced with Brent has large volumes. I've mentioned that as well. It's a spreaders market. I will do a live one to show you the kind of there's two things I want to show. Is one, hold on, bear with me 1 second. I'm just going to pause it while I sort this out. Hi, right, sorry about that. I've got this folder now. Here we go. So, shit. Oh, too many charts open for this. Right, okay. One of the things people ask me all the time about volume hitting the book. And variance of volume hitting the book is, if you look here, so we kind of rallied up a little bit up to kind of this 80 level, and then there's a big sell-off down here of 20 ticks, and there's hardly any volume in that. There's 28, 40, and no one's hardly got on the right side, creating what a lot of order flow traders like to call as imbalances. What's this? The aggressor or the market news, in this case it looks like it was going on around the settle. The aggressor or the market news created this volume void, and people think this volume void's come from like a big guy in the market or whatever. All that's happened is that the spreaders have two settings. The amount of distance that they have on their legs, so they need to make sure they're getting hit below the market in the front month so they can go and hit the back months. Or they've got what's called a resting quote. They might be quoting in the March, and they get hit in the March, and they immediately want to get hit straight away. Then they'll use that as an active leg into the front month. So what you see happen in these kind of rapid movements with crude, where no volume comes, where it just goes poof straight down here, and then it stabilizes for a bit, and you see all this volume, but this volume was never appeared in the order book. I'll discuss kind of how that happens in a second. But this is purely because velocity pulls those spreader bids. So you get to see the naked bids in the event of a selling right here, which is just actually quite small in crude. And then as price settles down a little bit more and time goes by, the iceberg and the no-show limit orders start to come back, which creates this balance back here. But no one's getting clipped here. The pull of liquidity is coming from the spread orders that have got a minimum tick lean. It's quite simple to do. You create a three-way spread or a four-way spread or a two-way spread. You lean on one side. Two-way spread's not going to be that dramatic, but you lean on one side and you always want to make sure you've got two ticks on the other. That's why you see that you've got this void here. And it happens, they did one here as well. And then all of a sudden it kind of settles back and loads of volume appears. And people kind of say, well, there wasn't 100 on the offer when this guy was selling here. Well, we'll talk about that in a second. So that's, what point was I trying to say there? Yeah, this is, and I'll go through and show in a live market how this happens. I'll try and capture some, but that kind of explains why you see these drops and these inside trades. And many of my orders are always on variable shows. So if I'm quoting into the futures ladder, not the options ladder, let's say I'm quoting 2022, and I'm prepared to do 50 on either side, probably wouldn't do that, maybe 35 on either side, I'll only show 6 or 7. That's why you see so much volume appear. You kind of, people say, oh, it's reloading, it's bidding, there's a big buy there. It's most people, spreaders and option market makers, just reload the amounts they've got to do at any one time. So if it's 2021 and you'll bid for your show for 5, but you'll do 36. You just basically bid to collect them there. If the market velocity moves quicker, you pull them, and then you put the bids back. And that's why it's with crude. There's so many variables of the calendar, the options. There's and most people are iceberging, and everyone says, "Oh, I've got an iceberg spot." Pretty much every order is. Why is it? If it's only offered for 5 and you pay it for 50, you get 50 done. Because that people want to be first to toxic. The VPIN, which is volume toxicity, they want to be the first to see the toxicity. That toxicity then creates momentum. They then pay the next offer, and up we go. Different market, more of an HFT space, but that's what's happening. Right, iceberg. Yeah, done. I will do this. These ones are highlighted in blue. I want to do them live so that you can kind of see them. But I'll get this uploaded. ICE is there's a second contract on ICE. I mean, that's, fundamentally, I've got a major problem with there's an order I found, where was it now? Bear with me 1 second. Just before the settle, right here. It's an order I found here, this bid here, a 96 for 96. This got given here. It actually got given on ICE 2 ticks lower. The guy was bidding here. And it was just purely an arbitrage trade that just went up 2 ticks. People say, oh, it's an imbalance, it comes off. Yeah, the market came off, but it's not related to that. There was an opposing bid that went through on the ICE WTI contract and the Brent contract at the same time. I mean, you can just sit and start unpicking the tape to prove all of these all day long. But I think sometimes the kind of key message to take away is that with CL front month, you're staring at 25% on a good day of total volume. So when you're looking at an order book, you're looking at an order book that's only 25% of total volume. And secondly, you're looking at an order book that's hidden. You're looking at spread of volume that's not really there, because they'll pull the offers and the bids because they're looking at they don't want to get legged to the other side. But I digress. I think that's a bit. I kind of link that back to people saying, "Oh, well, the pulling and the stacking of orders started to change around turning points." Well, it's fucking obvious. If there's a big level that people are going to buy to, I found another one. If there's if there's a bunch of levels where people are going to buy to, like they're coming into a VWAP or a Fibonacci, anything that any punter is going to come and buy into, you'll start to see that turn. You could use it to facilitate that turn, but again, I think, I'll do a section of this live as well. I'll highlight them, so I've got that. And the other one is, this to most people in an HFT space, you're so, sitting there in London or anywhere else in Europe, you're 120 milliseconds from the exchange. Okay, people, you live and die and be reborn 3 times with that distance. Unless you happen to be living in a hut or a caravan, just outside of Aurora, and you happen to have a internet provider that happens to be by chance, hub linked into Aurora, or you've got kit sitting in Zermatt, which is ICE's data center, which is downtown Chicago. You're pissing in the wind, because it's happened and it's been and gone. And people say, well, everyone's got to see those orders coming in. Yeah, that's true. You've got to be filled for the time, but they're first to see a cancellation. They're first to see a new order coming in. 50 lot comes in, bang, they see it first. You're just waiting for that to come in, going, I can see, there's a new order coming in for 50, it's moved down 2 ticks. Well, fucking guess what? It's even if you're 10 milliseconds, it's too slow. You spin and happened. But most traders, anyone outside of the USA is 100 plus. Sitting on TT, that's, or CQG or whatever, have got to go through sub-routing engines. You're not even got DMA, so your orders are going to their core platform, which then goes to their core routing engine, which then goes to the match. You look at the round turn trade time. That's, by the way, that's pure ping alone. That number there is pure ping alone. So, with you just zero chance of you getting hit on there. So you've got your piece of software going to your computer, going into your IP, your local internet service provider, long lining it across the Atlantic or wherever you might be, then coming back into the exchange, hitting the other guy, then coming. I would say end to end. If you're at 3, I don't know. I think if you're at 3, if you're all in and out of 300 milliseconds, I think you're doing pretty well. And that's not including your human reaction times, because that they're going to add time to that. But let's not debate that. Whereas the HFT guys sitting in the exchange are DMA. It means they're not going through third-party routing engines like TT, CQG, CTS, any of those guys. They're connected right in. They are seeing your cancellations first. They are unable to put their order in and see other people's cancellations, because it's just a time game. There's no advantage. No one sold any data before. There's nothing like that goes on with the CME. But if you're paying for DMA, which costs a lot more, you've got your own colo. You're sitting there in the data center, and you can probably front to back the whole lot in 9 milliseconds. And you're sitting there at 300 milliseconds trying to do order flow. You may as well just, burn the money or go and find a whore. It's just not going to happen. So that's my rant about why Crude's order flow. This works the same, by the way, for a few other contracts. You could argue, and some people, I don't know enough about. Hold on, why is this not doing this thing? Hold on. I don't know enough about the equity side and the indices side to know how much crossflow goes in there, but I do know that there's so much crossflow going on with Crude that you're A, staring at a small amount of the market space, and B, you're so far back in the queue for speed that trying to trade a non-transacted entity, i.e. the orders coming into the order book, is near on impossible. There may be other products that are less prone to multiple markets, less prone to the curve. There's nothing in the curve in the ES. The ES is all front month, all loaded, pure kind of risk-off hedging or risk-on hedging, and you might find a bit of that. But then you are really up against the big guns. You're really up against the guys that are on line of sight lasers between NYSE and Aurora. You're in a space that's just, you know, that you could argue that there's some opportunity there, but this point of this video is to say why crude is a shocker for order flow. And I will do those other videos. Thank you.